Pratik Agrawal, Chief Investment Officer with ASK Investment Manager, joined us live. Pratik, SGX is up by 2%. It is up 100 points plus. Do you think somewhere there is a case of misplaced optimism? Because even though the governor was very impressive in his first press conference late last evening, he does not have a magic wand. He will not be able to turn around things dramatically overnight.
No, fair enough, but the sense is that the measures that have been announced, take care of one or two worries that the market had. One was that capital account would get restricted going forward. The measures that have been taken, without saying so, kind of say that, it stays open, we want to deepen, widen the capital account. So that's a very strong positive message which has gone in. Second, the measures should result into higher dollar inflows in terms of deposits with banks, and hence when they are swapped with RBI would probably increase reserves a bit, and hence stability of the currency may be achieved. So this was something which was unexpected and this is positive in terms of currency outlook. Plus, any which ways trade data, the next trade data should show significant improvements. So, combine both and chances of currency stabilizing at current levels or better would be higher. So, markets typically, after the sharp sell-off that we have seen, would tend to bounce back once currency stabilizes.
So, Pratik, can I just challenge your argument there? The reason why Indian markets are underperforming is because of growth and what Fed could do. So yesterday's press conference will not fix the GDP growth, and it will not take care of the tapering problem. So what is the excitement all about?
One, there is a particular position the market takes in terms of things getting worse. The excitement is that maybe you have a guy at the helm who understands things better, whose body language kind of says, "Well, trust me, I know things," and you at least for some time would tend to believe that things would not get worse. So there is a correction to that. But yes, I agree. The next quarter numbers won't be good. The quarter after won't be good. Growth will slip, and hence one needs to be extremely selective in what one is buying.
Pratik, so what's the right investor approach then? Should one start nibbling into the beaten down pockets, for instance, banks?
Banks, to my mind, would be a good, nice trade for a day or two. But if you are looking medium to a longer term, that is probably the most horrible place that you can be in. Like Nikunj was saying, economy continues to slow down. The stuff that has been restructured in the past will again have to be restructured, and that will imply higher capital allocations. You have Basel III kicking in, PSU banks trading at one-time book or lower, raising money at even lower rates would imply everybody who is currently invested getting diluted even more. So, banks are probably, especially the PSU pack, is probably the worst place to be in today. I mean, save for 1 or 2 days of a trade-related bounce, no banks, to my mind.
So, what is your portfolio strategy at the current juncture? Last time when we interacted with you, you were buying pharma, you had exposure to two-wheelers, and you also had exposure, a little bit of exposure to consumer names.
So that says, we are looking at the market in terms of exporters. If you look at the problems that India has, current account, fiscal deficit, plus the fact that savings are going down and investment hence can't go up, we are just not there in the investment space at all. We believe current account has to stabilize first before the country can even think of achieving higher growth. Otherwise it just cannot achieve higher growth. So we are focused on export-oriented businesses. We believe government will bring out, they have already brought out few incentives for this space. Going forward, one should expect to see more. So export-oriented businesses with some amount of pricing power is the best place to be in. So pharmaceuticals rank the highest there, followed by large cap IT, which is where we are. Domestically, we believe overall things will slow down. One pocket where things will probably continue to be better than elsewhere and maybe even on the buoyant side would be the agri space. So we have some exposure to agri names and agri consumption names. So that is what our focus is. Consumption names with higher import intensity is something that we are clearly reducing exposure to.
The most standout announcement which came out last evening was that the new governor has put a firm deadline for new bank licenses. If Reserve Bank of India will issue new bank licenses, let's say 3 or 4 new licenses by end of Jan, what kind of implications do you think that will have for companies which have already indicated that they want to become banks? Names like Aditya Birla, Nuvo, Bajaj, Finserv.
No, so that's a fair one, but a difficult one. There are companies who, because of the houses they belong to, may have very large access to capital, and for them the opportunity would probably be taken as a positive. But if a name gets a license and in the process of ramping up their tier 1 and making the financial suitable for being a bank, need to raise money between now and January or maybe 2 or 3 months here and there, then given the depressed state of the markets, that would be a challenge and will end up diluting the current shareholders even more. So for that kind of companies, it may be a challenge, but for larger houses, it should be a positive. That said, banking is no longer a very attractive business that it used to be when the last round of licenses was given out. Basel III will hit soon, and let's say for PSU banks, the best of them would have an ROE of 12%. The best of private sector banks would have ROEs of 21-22%. So a business house should get into doing banking only if the existing businesses do not have an ROE of that order.
Pratik, now financials has a 30% exposure on the Nifty. As a fund manager, I'm sure you cannot afford to ignore all banks. So what do you own within the financials, and what is your current portfolio exposure to financials as a group?
So we are seriously underweight financials. We would have 16-17% exposure to financials in our portfolios. Like I said before, this is probably the worst place in the market to be in, save for very sharp rallies which happen because of whatever reasons. We are with retail-oriented, large, new private sector banks. We are with some of the NBFCs which are rural in orientation, because those are the guys, while they may have asset liability mismatches, but they have pricing power to take care of that. We do not have NBFCs which deal with auto loans or second-hand vehicle finances, etc. So that is how we are playing this space. Housing finance companies, especially the smaller ones, doing business in tier 2 towns and villages, very high names, can sustain high ROAs and hence ROEs. That's an area of our interest. Rural lenders, large new private sector banks who have a track record of generating sizable fee-based income. So going forward, clearly the ability of the manpower to generate sales will become more and more important. The passive banking that has historically been done by old private sector banks and most of the PSU banks would not be value accretive to shareholders, let me say that.
Pratik, what is your own sense of the metals pack, and whether or not there's still opportunity to catch the rally in any of the names?
A very difficult space to be in at this point in time. Yes, there are a few positives which are happening. For most of the domestic players, the downtick in the currency has given them sizable pricing power. So we have seen non-ferrous guys increase prices. That's a positive. There is some hope on guys who have overseas businesses because things seem to be turning around both in the US and Eurozone. So those businesses should start to do better. However, the fact of the matter is that most of the Indian entities who have large overseas presence are probably the only ones where there is no overhang of policy disruptions, etc., domestic concerns, and there the balance sheet is overly levered. The foreign subsidiaries are not generating enough cash to pay off foreign debt, and the rupee depreciation makes it even more difficult for the domestic INR earnings to pay off foreign debt. So, while there may have been some improvement in fundamentals, but still a very, very difficult space to be in, at best a trading kind of a space. We have chosen to stay away from this space.
Right, Pratik, really appreciate your time and thank you for joining us.